So you've now applied for a loan under the Paycheck Protection Program. You provided that application and supporting documents to your bank. Your bank is going to send that information to the SBA for approval. Once they have that approval, they're going to prepare loan documentation for, as I've talked before, a phase one of this, which is to actually get your loan. I will be your virtual loan officer to explain how that's going to work and further explain the terms of your loan, how it's going to work from the day that you get it to full payment, and hopefully in between there, a good amount of loan forgiveness as well. So given the times that we're in, where we have to do social distancing and there are orders that people are to stay at home, the documents that you sign are going to be sent to your email, and we're going to use a program called DocuSign. You may be familiar with this, you may not be, but it's a fairly simple process where we can verify your identity and make sure that all the documents are signed properly. Now, before you sign your documents, I want to make sure that you understand your loan completely, how it's going to be dispersed, how payments are going to be made, and what you're going to have to do to provide documentation to get part of your loan and hopefully the whole thing forgiven by the federal government through the SBA. So you've had your loan, you've signed it. Now, how can we get as much of that loan as possible forgiven? There's a calculation involving that, and the limiting factor in that is your payroll costs, including benefits. Just quickly, so that you understand, all of these items that are listed are forgivable, but the limiting factor is going to be how much payroll you've actually spent in those 8 weeks after you've received your loan. This amount here is going to be 75% of what's forgiven. So if you received a $100,000 loan and your payroll costs are $75,000, then you can get an amount forgiven for interest on mortgage, rent, and utilities of $25,000, because this is 25%. Obviously, this is to a maximum of what your loan amount was. If your payroll costs are more than 75% of your total amount, then obviously this will be a smaller percentage up to the total loan amount. But the limiting factor is this: if you have a $100,000 loan and your payroll expense is $60,000, then the maximum amount you can get forgiven for interest on mortgage, rent, or utilities is $20,000. Just so that you understand, 75% of what's forgivable is going to be payroll costs, and then 25% can be these amounts here. So as your virtual loan officer, I want to make sure that you understand very clearly the terms of a loan under the Paycheck Protection Program. First, your loan amount. Your loan amount is going to come directly off your calculation of the 2.5 times your monthly payroll expense. So that's going to come off your application. So this is from your app. The rest of these terms, this is the only thing that's going to differ between borrowers. All of these terms are going to be exactly the same for every borrower under this program. Your interest rate is going to be a wonderful 1%. The term is going to be 2 years, fully amortized. That means this loan and your payments are going to be based on paying back that full loan amount in equal payments over 2 years. But the payments are going to be deferred for the first 6 months. There's no payments to be made for the first 6 months. So you're going to make 18 equal payments starting 6 months from when you make the loan. So 6 months deferred. Now, collateral. When a bank does a loan, they typically want collateral to support the loan that you're getting. In this case, this is secured by a promise from the U.S. government that they are going to guarantee this loan. So there is no collateral, and I just mentioned guarantee. From the actual borrower, there is no guarantee for the bank side of this loan. So we have no guarantee But realize you are making promises to the United States government, who has a pretty good track record of being paid back on things. This, though it is a loan from your bank, this is an agreement between you and the United States government, and you need to understand that. But it results in you getting a loan at very favorable terms, and if you use the funds correctly, it actually gets forgiven, which then changes this because you're actually getting that money for free. The loan is forgiven. So I've explained the specific terms of your loan. Now I'm going to talk about the repayment of your loan. To begin with, I'm going to do it based on just the loan portion, as if none of the loan is forgiven, just so that we get a clear understanding of how this loan is going to work. So for calculation purposes, I've done some calculations here based on a $100,000 loan. Obviously, this loan amount comes from your application and what is actually funded to you. Let's use a loan date of April 7. Because all payments are deferred for 6 months, your first payment is not going to be due until November 7th. Again, we're not talking about forgiveness here. We're talking as if $0 was forgiven. Your payment amount on November 7 is going to be $5,627.70. Now, you will have to make, starting on November 7th, monthly payments of $5,627.70, because you will do that for 18 months, and that will fully pay off your loan and interest for your 2-year, $100,000 loan under the PPP program. So interest does start from the time that you take money for your loan, but that interest is deferred and payments start on November 17th. You make 18 equal payments of this amount until the loan is fully paid off. So as I said, there's two parts. There's the loan and there's the forgiveness. We're not going to get into the details of the forgiveness, but the amount of the forgiveness. This next part may be surprising to you as a loan applicant, but this is how the loans are going to work in terms of repayment. So as I mentioned, $100,000 loan, you have 6 months where no payments are due, and then this is your payment here. Now within those 6 months, you should provide the documentation to your bank. You really should provide it as soon as that 8-week period is up. And those documents will be provided to the SBA, and they will explain what has been forgiven of your loan. And that amount forgiven is going to forgive principal and interest accrued up to that point on that principal. Now for a simple explanation of how that's going to work in terms of your repayment, let's just assume that $90,000 is forgiven. This aspect of the loan has changed a number of times, but this is how it's going to affect your repayment, and it might not be what you expect. So your original loan was $100,000. Within the 6-month period where your payments are deferred, you provide your documentation, and $90,000 of your loan is forgiven. So now you have a loan amount of $10,000 at 1%. So that loan is, the payments on that loan are deferred for 6 months, but your first payment is still based on that original loan amount. So your first payment is still $5,627.70. Your second payment then will be everything left to pay off the $10,000 plus 1% interest. So this loan will actually be paid off in 2 payments, not in 18 equal payments over time, because the loan payment is based on the original loan amount, not the principal amount after 6 months. This is something that's changed recently, and you need to understand that you can't just use those funds for a number of things and think you have a long time to pay off that $10,000, because you can imagine if your loan starts getting bigger, if this was $1 million, this is a $50,000 payment if $900,000 is forgiven. a $50,000 payment that you're going to have to make on that day 6 months from when the loan is originated. So you may be asking, why is it that you can't pay the unforgiven portion of your loan over the 18 months? The difficulty is that your original loan is going to require some documentation. If we were to change every one of those loans to an 18-month loan based on the amount that has not been forgiven, that's a whole lot of documentation for every bank across the country, and these loans, you have to remember, are being done for every business in the United States. So your loan documentation is going to remain the same. It's just that now with with your payment based on the original loan amount, you're going to pay off that loan very fast. The information contained in this video is not to be construed as legal advice. This is for informational purposes only on the Paycheck Protection Program. This program is changing almost daily, and this video was prepared on April 7th. So everything that you hear, bring it to your legal advisor or financial advisor so that they can give you up-to-date information and information specific to your business.